He's known for his bearish and contrarian views. Our next guest says investors have become too negative. The result? Equities across the globe, including European stocks, have become attractive. Mark Faber is the author of the Gloom, Boom, and Doom Report, joining us from Zurich this morning. Mark, you're enticed by cheap stocks in Europe. Tell us more.
Well, let me explain you where I'm coming from. We have record low interest rates on cash. You're not earning anything. In some countries, you have actually negative rates. In other words, when you buy government securities on the short end, you're bound to lose some money. And the 10-year bond yields in most countries is also extremely low. At the same time, we had a high on the S&P. This year on April 2nd at 1422, we're down now less than 10%. But most European markets, they peaked out a year ago in May 2011 and are down very substantially and are approaching the lows or exceeding the lows of 2009. So in Europe, what you have are many shares of good quality companies that are yielding 5 to 7%. So I'm saying they are relatively attractive compared to cash and to bonds. I'm not saying that they will go up, and in fact I think a global bear market has begun and we're going to go lower. But if you look 10 years out, I think if you buy a 10 years US Treasury at a yield of 1.6%, that is the maximum you will earn, whereas companies that have dividend yields of 4 to 7%, I think will provide you with higher returns.
It's all about the search for yield. You mentioned the 10-year Treasury yielding 1.6%. I know you're not a fan of government bonds in general. In fact, last time you were on with us a few months ago, you said they were in a giant bubble, yet everyone is still pouring in to U.S. government bonds. So is this the biggest bubble ever, and when does it pop?
Yes, I don't know. If you had asked me about the NASDAQ in December '99, I would have said this is the biggest bubble ever, and yet the NASDAQ continued to go up 30% until March 21st, 2000. And then what happened to the NASDAQ, and how have these people fared that invested in the NASDAQ in the final months of '99 and early months of 2000? It's been a disaster. And I think the government bond bubble will also burst, but I don't know, tomorrow or in 3 months. I suspect actually maybe sooner than later, because the consensus is now buy U.S. government bonds.
But
I
Mark,
can see why people buy U.S. government bonds.
But Mark, if you're predicting a global recession, then where do you want to be? If you're predicting a bear market in stocks over the long term, wouldn't you want to be somewhere safe?
Well, not necessarily, because you can have a recession that has some inflationary symptoms in the system. And so in a global recession, what will also happen is that tax revenues will collapse and the fiscal deficits will go ballistic. And so the quality of government paper will deteriorate. I think maybe if you believe in bonds, you might be better off in corporate bonds of high-quality companies.
Okay, what about gold? I know that you've also liked gold. Is that somewhere where investors can go to preserve capital during gloomy and boomy and doomy times that you're predicting?
Well, I'm not sure that gold will make a new high this year, but I think we've bottomed out, and I think that some gold mining shares have become very, very inexpensive compared to the reserves they have. And I think that in the current environment, where it is clear that the worse the economy becomes, the more the money printers will be at work, that to own a currency whose supply cannot be increased at the will of some clowns that occupy the central banks is a desirable investment.
You're not a fan of any currencies, that is? I mean, gold you like because it's the anti-currency, but if you had to choose of the majors, where do you want to be right now?
Well, I think the Singapore dollar is a relatively stable currency. I believe that the Thai baht, the Malaysian ringgit are relatively solid currencies.
So not the euro, not the U.S. dollar.
Well, I kind of like the U.S. dollar. I think we had a big move in U.S. dollars. I think it's correcting now. I think a further move will come because as global liquidity tightens, it's U.S. dollar friendly. But longer term, you can't be very optimistic about the U.S. dollar.
Well, you have a lot of negative views. One thing I want to leave you with, I know you're looking at natural gas and how this could potentially help the U.S. economy. So give us something positive here.
Well, I think it's irrelevant whether it will help the U.S. economy meaningfully, but what is relevant is that people believe that the U.S. could become energy self-sufficient, which is a possibility if essentially natural gas is exploited properly and you don't pay attention to the environmentalists who want to prevent the fracking process. But in general, I think that the U.S. is in a relatively favorable position if they can exploit natural gas as it is now, because the natural gas price in the U.S. is much lower than what it is in Europe or in other parts of the world.
All right. Our thanks to Mark Faber, author of the Gloom, Boom, and Doom Report. He likes the Singapore dollar, he likes corporate debt, and some cheap companies in Europe.